Hello, and in this problem, in this video, I'd like to talk about problem 10.1a, which is basically just a bunch of journal entries for different liability transactions, typically current liability transactions. So let's just briefly look through it. First transaction, purchase merchandise and account, 175,000, terms net 30. So this is you would debit inventory, credit accounts payable, 475,000 here, right? Because terms net 30, so there's no discount. Issued 30-day 6% note for 175,000 to Kirkwood on account. So what they're doing here is that they're swapping the payable for a 6% annual rate note. Of course, it's a 30-day note, so the interest rate will need to be prorated for only 1 month, right? So it's a 0.5% a month note essentially. Then we have a redemption of the note, so we just need to reverse the payable, credit cash. Then there's another note for $400,000 against a 45-day note. 5% is the annual rate. You need to take 45, prorate the interest over 45 out of 360 days. Purchased tools Beijing's 45,000 60-day note to Poland, which discounted the note at the rate of 7%. Now this is the discounted note. For discounted note, your textbook talks about it on page 480 in the discussion of short-term notes payable. For discounted notes, you record interest up front, right? Interest is essentially kind of a deduction to the proceeds. You still are liable for the full amount. You still need to, by the way, prorate interest 60 out of 360 days. And then you have the next transaction deals with essentially refinance, where you swap one loan for another loan. And then there's a payment here, another payment, purchasing equipment with a note payable, partial cash payment. There's a settlement of the product liability lawsuit, so you need to debit liability, credit cash to reverse the original accrual. And then there's finally the payment of the note. So this is kind of these are the types of transactions. So now let's quickly journalize them so that we have actually recorded them. So let's record some journal entries. The very first entry says purchased merchandise inventory on account from Kirkwood, 175,000, terms net 30. So that is just a debit to inventory, 175,000, credit to accounts payable, 175,000. And then it says, so this was 3.1. Now 331 issued a 30-day 6% note, 175,000 on this account. So the refinance and the payable with a more long-term payable, there's a 6% annual interest rate on it. It's really 0.5% a month. Remember, so well, the first entry on the date of issuance, they need to simply debit AP 475,000 and credit note payable for note payable 175,000. Now, when the month passes, a month later, you're going to have to record a 0.5% interest on this, because it's 6% for a year, so over 12 months, it's a 0.5%. So on 4/30, they actually pay off this note, right? So I told you there's going to be a 0.5% interest on it. 0.5% interest on 175,000 is $875. So they debit note payable because they're paying it off, 175,000. They have an interest expense of $875, and cash is the combination of this two, 175, 875. So that's that. On June 1, borrowed 400,000, issuing a 45-day note. Again, interest will be over. You need to prorate. It's a 45-day note. 5% is the annual rate. But on June 1, you simply record the actual issuance of that, which is simply you get cash of 400,000 and credit note payable 400,000. And then on July 1st, you issue another note because you're buying tools with a note. The note itself is discounted, meaning, as your book mentions, you need to subtract the discount or the interest from the proceeds. So this is on July 1st, so it's going to be 7/1. Let's write that in a different piece of paper. So on 7/1, you are debiting cash. You're going to have a note payable. The note payable which is due to you owe is $45,000. Now remember, you're discounted by the amount of the interest, which is in this case 6%. It's a 30-day note. So actually, I misread this. This was 7%. So 7% over 6 discounted over prorated over 30 days is $525. So this needs to be here. This will be $44,475. So I was looking at the wrong line here. And then on July 16th, so this is 7/16 now. It will have. It pays the interest on the note renewed to Triple Creek. The original Triple Creek note was a $400,000 note borrowed on June 1. Then remember, it was a 45-day note. Again, the original issued the 5%. So that works out to be, if you take 7%, 6% times 45 divided by 360, right, times 400,000. So this was 5%. Times 400,000. That works out to be $2,500. So what they're doing is you have to record interest expense, which is $2,500. They are paying cash $2,500 for this interest. Now then the next transaction, so they are swapping one note for the other. So they need to debit out the note payable which they had, which was 400, which was the old. This was called Triple Creek Bank, and I'll call it old 400. And they're swapping it with a new loan. They're refinancing it. I'll call it note payable new. 400,000, right? So they basically refinance the old loan with a new loan. So that's that. And then finally, August 15th, they're taking they are paying this new loan, which was another 45-day loan. That works out again to be at a 6% interest rate, 400,000 times 45 over 360 times 6%. That ends up being $2,000. So on August 15th, they debit note payable. Because they paid it all $400,000, they have an interest expense, debit of $2,000, and credit cash for $402,000. That's what they do. So that's August 15th. August 30th, they pay the Poland company note, which was a $45,000 note. Remember, which was originally discounted, so you don't need to record any more interest because the interest was recorded up front. Essentially, it's a discount, so they need to now they pay the full amount of the note, which is 45,000, and credit cash of 45,000. And then we're up to December 1st, 12/1. They are purchasing equipment for $260,000, paying $40,000 up front in cash, and issuing a series of 9% notes for $22,000 each, coming due in a 30 days interval. Well, I mean, we can talk about how to later account for those notes, but notes interest. But at this point, it's just equipment. They're buying for $260,000. They're crediting cash in the amount of $40,000, and the difference goes to notes payable, $220,000. This is what we get here. And then on 12/22, they have they pay off the liability, which you have to understand. The original entry was I mean, they don't pay it off; they settle it, right? And they have to accrue a loss, so they have to debit litigation loss of in this case 50,000, and credit accrued liability litigation payable, I guess, or something like that, of 50,000, because it's a contingent liability in this case. And then they've the last the December 31st, December 31st, they pay off the first note. Remember, there were several notes, and they were payable in 30 days interval. Now, the note itself, the amount the note of, was 22,000. Now, remember that you also need to recognize some amount of interest expense for 30 days, and there's going to be a cash entry. Now, how much interest was it? Well, this is 22,000 times 9% times, these are 30-day notes, right? 30 out of 360. So that works out to be $160. $165. So this is 22,165. This is what we get here, and that's pretty much the journal entries that we have for part one of this problem. For part two of the problem, it's asking you to journalize the product liability expense, so of $80,000. So for that purpose is part two. All you need to do is you debit warranty expense, 80,000, credit warranty liability, $80,000, and it's asking you to calculate remaining notes owed to Greenwood. Remember that now I have I paid off one note, so what I have is I paid off one note here. So what I started with 220, I paid off the 22,000. So what I have is 198,000 of liability left. Those are 9% notes, and this is only 1 month. So we need to kind of basically take 30 out of 360. So let's quickly calculate that. That's $1,485. So what you need to do is debit interest expense. $1,485, credit interest payable $1,485. That's pretty much problem 10.1a.